6 months is hard to explain, really. In June, the OPEC Plus group got together and said sanctions on Iran, it's going to shoot the oil price up, so they agreed to increase production. And then there were waivers granted, and that dropped the price. And now too much, they've overshot, and they may have increased production a little bit. I think it's actually the market working pretty clearly. I think it's been maybe surprising political signals that have made it move so fast. But I think the market's coming into balance the first quarter of the year.
Joining us right now is the Schork Report publisher, Stephen Schork. Good to see you, sir. Thanks so much for being here. What's your take in terms of the supply out there? The U.S. is now the largest supplier, right?
Absolutely, and it's by a long shot there, Maria. We're probably today producing in excess of 12 million barrels a day, and to a great extent, this has offset some of the initial efforts that have been made by OPEC to bring some of these barrels off of the market. Now, of course, we've had a nice little rebound in oil prices in January. And last time I was here, we expected that, but we also expected that upward momentum to stall. We have to keep in mind that the price rise here in January is really not a function of improving economic outlook or demand. It's more of a function of how weak oil prices were in December, as pretty much all global markets sold off, and crude oil was not immune to that, and it sold off in sympathy. So really the rebound in oil prices today is more of a function of how weak they were in December.
Oh, so it's really a bounce back then, Mitch.
Yeah. It's got. Yeah, I'm sorry.
No, go, Stephen. We talked about in the past the fact that if we have too much supply, we may see the frackers sort of backing off a little bit. Story in the Wall Street Journal today about the natural gas exploration companies sort of backing off. Is this something that could be a challenge for our economy because we're going to sort of lose production because they're worried about the excess supply and thus maybe some workers falling out of the workforce?
Yeah, absolutely. E&P and the oil and gas sector are major contributors to the rebound in jobs. With regard to, we'll break down the two commodities here. With oil, no, I'm not worried about any sort of significant pullback in production. Oil prices for the better part of last summer were in a $65 to $75 range. We saw a significant amount of hedging for 2019 production. So all that forward production was sold. So you're going to have actual production now to offset those paper shorts at that point. But this brings us to natural gas. That's a major problem because a lot of this oil is produced in West Texas. We bring up a lot of natural gas with that crude oil. It's called associated gas. So we already have a situation where we're overproducing in natural gas. And because crude oil production will remain so strong, that will actually boost natural gas production even further. So on one market, on the crude oil side, I don't expect a significant pullback in production, but the natural gas market is absolutely challenged. And so are those jobs in the new year.
I want to ask you your reaction to what IHS Vice Chairman Dan Yergin said in Davos when I asked him what the big issues are for oil. Listen to this. So where are we now? What are the big issues around oil from your standpoint?
Well, I think there are really two that are wrapped around the oil price. One is China, not demand in China, but what happens on the trade talks is one thing, and the slowing growth, and that's one of the factors. And the other is the rate at which U.S. shale grows and how the rest of the world responds. We're seeing that February is expected to be slower growth. Investment was down a little bit, but we think that this year we're going to add another 1.5 million barrels a day of supply from the United States.
What do you think about that, Stephen? China and shale, the two big issues, according to Dan Yergin.
Yeah, absolutely. And China was certainly a concern with the sell-off back at the end of the fourth quarter, and it certainly is a concern as we go into this quarter. Let's keep in mind, though, this quarter demand is always weak. We have the post-holiday lull in commercial and industrial demand. Winter roads have always queer gasoline demand. And at this point, we're going into the refinery turnaround season. So refineries are buying fewer barrels of crude oil. So that certainly is a concern. I absolutely agree that U.S. production is, as I just said before, because of those hedges, is going to remain extremely robust through this year. But keep in mind, OPEC is already bringing barrels off of the market. Once we get through the winter and that production, Russian production in Siberia, that production will begin to hold off. So that should be able to help offset the fall or the concerns with demand.
Now, I just wanted to tie the Venezuela situation with China and Russia, because Russia invested $5 billion into the state oil company. So with this, impending, some would say, collapse of the Maduro government, what does that mean for the Russian investment and then Venezuelan oil?
Oh, they have absolute problem, and it's not just Russia. They're both ideological. They're in bed with one another. So is Beijing. Maduro is a wannabe Castro. I don't think there's any doubt with that. They have significant amount of investment in that country. But look, the United States, along with Europe, along with the majority of South American countries, are saying Maduro has to leave. So certainly this has been a long slog watching the Venezuelan economy circle the bowl for the last 5 years, where I think we are in the end game. So we're at a situation now here that where the United States has cut back its dependence on Venezuelan oil, but you have a few companies out there, Citgo, of course, which is wholly owned by the state-owned company of Venezuela. You have Valero, which has a significant, in some of the refineries, more than 90% of their imports of sour oil comes from Venezuela. The same with PBF and the same with Chevron. So while the majority of U.S. has cut back its dependence, you still have a few companies out there that are extremely vulnerable to the situation in Venezuela.
Right.
Net. I do think it is bearish for the market. The market has had the opportunity for the last 2 years to price in the loss of this Ven oil. It is priced in. And what's interesting, this production of U.S. shale, it's a lighter oil. It's an easier oil to refine. It gets a lot of gasoline out of that oil. So we actually have a situation where we have too much gasoline here in the United States. We actually have a glut. Certain key markets down on the Gulf Coast and in New York Harbor are at record highs. So net, it looks like Vens is actually a bearish scenario for oil.
Stephen, it's great analysis as always from you. Thanks so much. We will see you soon.
Thank you,
Stephen
Maria.
Schork joining
Absolutely.
us. Coming up, the Russia probe. House Intel Committee ranking member Devin Nunes details what's at the center of the memo outlining the scope of Mueller's investigation. What he told me yesterday on Sunday Morning Futures. Coming